Is Affirm a buy or a sell? Let's get started with the model. This is a large cap company, 22 billion market cap. They're trading at $71 a share, and they have 313 million shares outstanding. Affirm offers short-term loans. It was founded in 2012, headquartered in San Francisco, California. Let's look at their financials. The way you value a company is you estimate the free cash flows into the future, and then you discount those numbers back to today's value. That's what we're doing in this video. And free cash flow is cash flow from operations minus capital expenditures. They did have negative free cash flow in 22 and 23, almost 300 million in 2024, almost 400 million in the trailing 12 months. Pretty good margins. They convert 15% of their revenue into free cash flow. Net income is the profit or loss on the income statements, revenue minus expenses, and that's negative every single year. Revenue is a sales for the company, and that has a nice upward trend from 1.3 billion to 2.5 billion. We estimated 4 years of future free cash flows. We also estimated a terminal value, it's all cash flows past year 4, that's 28 billion. We discounted those numbers back to today's and weighted average cost of capital. We get a value of the company of $24 billion. We divide that by 313 million shares. And we get a calculated stock price of $77.10. They're trading at 71, so they're trading at an 8% discount. It's a buy according to the model. Do you think it's a buy or sell? Let me know in the comments. There are 105 companies in the same industry as Affirm, and if they have a number in red, they're worse than the median. If they have a number in blue, they're better. They spend 168 million in capex, which is more than the median. A really high debt-to-equity ratio. For every dollar of equity, $2.50 of debt. They don't pay a dividend. They generate 380 million of free cash flow. A lot lower than the next 3 companies, and they're all smaller in market cap. They rank 12th in market cap, 22 billion. They're trading at 8 times book value, which is worse than the median, better than the average. We can't look at their PE, negative earnings. They're trading at 58 times free cash flow, a bit pricey, and 9 times revenue. They generate 2.5 billion of revenue, but their 5-year annual revenue growth rate doesn't look so great. It's only 1%. Pretty much the smallest on this list. I'm not sure about the NA. They're trading at their 52-week high, so stock seems a bit inflated. Their current stock price is almost triple their 52-week low. Their 50-day moving average is 49. That means if you took the stock price the last 50 days, summed it up, divided by 50, it would be 49. 200-day moving average 37, 100-day moving average 41. They already hit the golden cross. That's when the 50-day moving average crosses above the 200-day moving average. And that's considered a bullish signal. MongoDB's 50-day moving average is below its 200-day moving average. When the 50-day moving average crosses below the 200-day moving average, that's a death cross. That's a bearish signal. If you put $10,000 into this company when they started trading, you'd have $6,200 today. That's a 38% loss. At one point, you would have been up about 35% or so. At another point, your $10,000 would have been like $2,000 or maybe down to $1,500. So the stock definitely moves around a lot. So to summarize, I have them trading at an 8% discount, ranking 6 out of 10. I think it's a good stock. I definitely have to do more homework. Would I buy it short term? 3 out of 10. Possibly long term, 5 out of 10. Ratios look pretty weak, 3 out of 10. Financials look good, revenue looks really good, and now they have positive free cash flow. So it's a 7. I was thinking an 8, but I gave them a 7. Let's take a look at their 10Q. This is for the third quarter of 24, third quarter of 23. Revenue last year, $500 million, now 700 million. Merchant network is up from 145 million to 184 million. Card network, 33 to 47 million. Then you have interest income, the interest they receive on the loans they provide. That's the big one, 377 million. Last year, 262 million. The gain on sale of loans, 64 million. That's almost double. Service income, 25 million, up from 20 million. So everything is up. Let's see if they give a different breakdown of the revenue. Let's look at this income statement. It has percentages. Total revenue up 41%. The biggest gain was from the gain on sale of loans, up 86%. The smallest gain, 26%, from merchant network revenue. Their expenses are higher than their revenue, so they have an operating loss of 130 million. Last year, an operating loss of 209 million. Their biggest expense is credit losses. These are losses on the loans they provide when people don't pay back the full principal, 159 million. Marketing, 145 million. Technology, 134 million. G&A, 138 million. They had a gain of 34 million in other income. $1.9 million in taxes, so they have a net loss of $100 million. Last year, a net loss of $172 million. Last year, they had 304 million shares outstanding, now 318 million, so they added 15 million shares. But their loss per share improved. Last year, a loss of 57 cents, now it's a loss of 31 cents. Let's look at their balance sheet. Total assets, $10 billion. Their big asset are loans. Their main asset is the loans they provide, $6.3 billion. They have $1 billion of cash, $300 million restricted cash. They also have over $500 billion of goodwill, so it looks like they do some acquisitions. They have $7 billion of liabilities. Their main liability is notes, $4 billion. In order for them to fund the loans, they have to add these notes. They also have convertible senior notes, $1.2 billion, and $1.7 billion of debt. Here is a breakdown of the $1.7 billion of debt. $250 million is due next year, $800 million due in 2026. $250 million due in 2027, $200 million due in 2028. Assets minus liabilities equals equity, $2.8 billion of equity. They raised $6 billion from selling their business, from selling stock. They lost $3.2 billion from running their business. Let's take a look at the statement of cash flows. The first section is operating cash flow. Even though they have negative net income, they still generate positive cash flow, positive $200 million, double last year of $100 million. In their investing section, they had a cash outflow of $570 million. Most of that was providing loans, also loan proceeds. They spent $44 million on PP&E. Last year, $36 million. Most of their PP&E is software. They don't really need fixed assets like equipment and buildings. In their financing section, they added $3.2 billion of debt. They paid back $3.3 billion of debt. And they received $750 million from a securitization trust. I actually worked on securitizations for several years when I was in New York City. Let's take a look at a stock on Simply Wall Street. Its last price, 72, 22 billion market cap, up 5% in the past week, up 88% in the past year. Here's the stock price since it started trading. It peaked in 2021 at 163, and then by the beginning of 2023, it fell below $10. If you bought it the first year, that must have been a nightmare seeing it go below $10. It is coming back up there. It's getting close to 70, about 55% lower than its all-time high. Simply Wall Street's valuation is $3. I think this is the most overvalued stock I've ever seen on this website. 17 analysts priced this stock at 56. They also say it's overvalued. Their revenue in 2021 was under $1 billion. The forecast for 2025 is $3 billion. Then $3.8 billion, then $4.7 billion. Here's their debt since 2019. It was $585 million. Now it's its highest ever, over $7 billion. And equity is a good amount lower than their debt. It used to be pretty close to their debt. Now equity $2.8 billion, debt $7 billion. And their cash is $1.9 billion. They do have a good amount of cash. The CEO's salary was a paltry $10,000. Now it's a paltry $38,000. You rarely see the CEO's salary under $100,000. Total compensation $500,000, tenure as CEO 13 years. In the past year, a couple insider sells, no buys. 68% of the company is owned by institutions, 16% by the general public, 6% by insiders, and 3% by private companies. The LA firm Capital Research is the biggest shareholder at 13%, then Morgan Stanley, Vanguard. Shopify, if this stock went up a lot or down a lot, that would affect Shopify stock. Their employee count was 900 in 2020. It got up to 2,600. Now it's down to 2,000. And the ticker trades on the NASDAQ and Mexican Bolsa. If you want to get your own discounted cash flow model in Excel, watch the video in the top right corner. Thanks for watching.